Hey everyone. The Middle East conflict has created a range of economic complexities and potential headwinds for the U.S. economy and commercial real estate. And while the effects of elevated oil and gas prices are readily apparent, a variety of other commodities that transit the Strait of Hormuz could spur economic headwinds. The price of some fertilizer components needed for farming and agriculture have increased by more than 50%, while the price of helium, which is needed for the production of semiconductors and electronics, has risen by 10 to 20%. In addition, trans-Pacific shipping costs have risen by 35%, and flatbed trucking, which is used to move shipping containers across the U.S., have experienced a 26% cost increase. The March Consumer Price Index inflation reading came in at 3.3%, up 85 basis points from February, the largest month-over-month increase since 2021. And the March Producer Price Index inflation rate, which tracks the cost of inputs for manufacturing and other businesses, jumped by 60 basis points to 4%. Together, these indicators suggest inflation risk may be significant and more tenacious than previously believed. At the same time, the rising cost of fuel and the persistently elevated uncertainty continue to weigh on consumer sentiment, which hit its lowest reading on record in March. And job creation remains well below the historical norm. This combination of elevated inflation risk and slowing economic growth will make the Federal Reserve's policy decisions increasingly complex. On one hand, there will be pressure to keep interest rates higher to mitigate inflation risk, while at the same time, there will be pressure to reduce rates to support economic growth. At present, Wall Street investors are signaling just a 30% probability of the Fed making at least one cut by the end of the year. But earlier this year, before the onset of the Middle East conflict, Wall Street was baking in 2 or 3 rate cuts in 2026, and that belief pushed the 10-year Treasury below 4%. But after the conflict began, the 10-year advanced nearly 50 basis points to 4.4% before settling back down to the 4.3% range where it's been for the last couple of weeks. When the 10-year surged, commercial real estate lenders began to widen their rate spreads. But over the last couple of weeks, it appears caution has begun to abate, drawing commercial real estate lending rates back into alignment with where they were in the fourth quarter of 2025. With bank lending rates reverting back to the low 6% range for commercial assets and agency-backed multifamily lending in the mid 5% range, commercial real estate transaction activity should sustain momentum. Capital flows into commercial real estate targeted funds increased by 36% in 2025 compared to 2024, with an estimated $285 billion of undeployed capital targeting the sector. The competitive yields of commercial real estate, coupled with durable cash flows and some inflation hedging advantages, are becoming increasingly enticing for investors. Financial market volatility, uncertainty, and rising inflation risks all reinforce investment into hard assets. Should capital flows into commercial real estate increase as expected, transaction velocity should continue to rise. Last year, commercial property transactions over 2.5 million increased by 17.3%, and the Mortgage Banker Association is predicting a 15% rise in commercial real estate lending activity in 2026, and that includes both refinance and transaction activity. So while the conflict in the Middle East continues to raise uncertainty and increase inflation risk, it also bolsters the value of commercial real estate as a diversification strategy, an inflation hedge, and as a hard asset with durable value retention. These characteristics reinforce the commercial real estate outlook for investors who keep their eyes on the horizon.